What's up, guys? And I'm going to be showing you my divergence trading strategy. I call it Nico's special divergence trading strategy because that's my name. So yeah, pretty much we're just going to be talking about the hidden divergence, trend, everything. So like I said, we're going to be talking about the entries and the actual trading strategy itself, but we're also going to be talking about risk management when it comes to this strategy in particular. And we're also going to be talking about some other little technical things at the very end. Just to help you get better entries and make sure you don't lose money, because that's the big thing. Just win money, right? So before we get into this, one of the key things about this trading strategy is divergence. All right, we know that there's two different divergences. Ignore the exaggerated because we don't really trade that at all. So let's focus on these two divergences right here, hidden and regular, right? So let's say we're in an uptrend, right? And then our OBV, which is the indicator we use, is going down. We would normally place a short and then it would go down, right? The problem is it's so hard to time the reversal of a market that it's kind of useless, honestly. And you don't really have an exact place to put your stop loss, and you don't really know where to take your profit, right? You can do a channel, the top of the channel, bottom of the channel, but chances of it hitting the top of the channel and coming all the way down are really small. If you guys are in the trading group with Justin, you're going to see that. You know, a lot of these normal divergences are the ones he loses. There was a gold capture, a gold trade for 80 pips, all right? And it was actually hidden divergence, which is what I'm going to show you how to trade, which is why he won. The big reason he wins is because of hidden divergence. He actually has his own trading strategy, which if you haven't watched, you have to watch because it's very important for this video, right? He traded off only hidden divergence and grew his account super big, right? So, like what I was saying, is regular divergence, no. Hidden divergence, yes. All right. Here's two examples. On this side, we see prices going lower. We see this little pullback, but we see the indicator went higher, right? What that pretty much is telling us is that volume is starting to enter in the market. With a little bit of volume, price shot down, and with a ton of volume, price barely went up, which means there's a lot of pressure towards the downside, right? So if you sell, it's most likely a pullback and it'll go down. So you're pretty much catching the trend. If you look right here, it says it right here, going with the trend. That's very important. When you trade with the trend, you have a higher chance of success. You know, why try to time the tops and bottoms when you can just hop right in somewhere in the middle and ride it down, you know? That's what makes the most sense to me, and that's the best strategy to trade. So remember, only hidden divergence, no regular divergence. Only hidden divergence, okay? So like I said, trade with the trend. We're only looking for the hidden divergence trades that go with the trend. So here's a really good example, right? Ignore the right side of my chart and pretend this is the on balance volume. It's pretty much the same principle, right? You see prices going up, higher highs, higher lows, but what do you notice here? It's a lower low down here. What that means is a hidden divergence, okay? So if you place your buy somewhere down here through other confluence factors, which I'm going to show you, it shoots all the way back up, okay? Not only that, but you have a very tight stop loss and a very good risk to reward. Okay, I'm going to explain later in this video how you set the stop loss, take profit, all that. But this is pretty much the principle, right? Uptrend, bullish, hidden divergence, which means it's going to go up, and then see that? It goes right on up, right? And I'm pretty sure this is a Fibonacci level as well, so that's even more confluence and other factors that you can incorporate into this strategy. The third part of the strategy, which is pretty much the last part, but the most important part, is the currency strength indicator. Okay, what this tells you is the overall moves of the, or overall strength of the move of the trend itself, right? So let's go back to this example, the trend is going up. How long is the trend going to keep on going up, right? If the strength indicator is saying, hey, this pair is really strong, it's going to keep going to the upside, then yeah, why not buy? It's just a pullback, you know? If it's saying it's starting to get weak, then most likely it's going to reverse like it does here and go down. You know, and you don't want that. So that's what this currency strength indicator helps you do. It is extremely helpful when it comes to timing these entries, okay? So I have the website at the very end of this video. You guys can check it out. There's two different ones I use. I use this one here, okay, and I use this one here as well. You're going to see it when you click on the website and find it, you know, you're going to find these two settings, right? This one here is for this chart right here. Okay, it's a lot of different lines and stuff, and if you don't understand what that means, that's okay. But pretty much what it means is the higher up the line is, the more strength it has, right? So on this chart, for example, you see the euro is the red line, it's super high, and this pink line is the NZD, right? So if you're trading the euro NZD, you would buy that pair because the euro is stronger and the NZD is weak. And if we look at the chart, it actually did shoot up. So that's pretty much what this currency strength indicator tells you, okay? Now, the one I prefer to use, because this is more like every 5 minutes updated, it's not really very accurate, but it kind of gives you an overall gist of where things are going for the day, is this one right here, okay? It's this one right here, all right? When you click on this, you're going to see 3 different time frames: short term, medium term, long term. I click through all those, and if they all agree, that's great, but I usually put on custom. Here's my settings right here. You can do 50 or 100 bars. It doesn't really matter. What matters is you have 1 hour, 4 hour, and daily. If you look at the way Justin time trades, he uses these 3 time frames for that very reason, right? This is your short time frame, the one we're actually trading, right? We only place trades on the 1 hour. These are more long-term time frames, right? Because if you look at this, right? Let's pretend this was the 1 hour chart. This is a long time. And I can tell you right now, this is close to 48 to 72 bars from here to here, which means it's going to be probably 2 to 3 days of a time frame, right? So 2 or 3 daily candles, at least 18 4-hour candles, and 72 1-hour candles. So that's why these settings are very helpful. They help you get into those trends and tell you, okay, this pair's strong, this is not strong, right? So how do we use this, right? What this is going to tell you is the relative strength. So it's the strength of the thing itself, right? So just the US dollar, or just the euro, or just the Japanese yen, sorry. The more red it has, the weaker it is. The more blue it has, the better it is, right? Recently, we know all the problems going on with gold, or with Iran, especially with the United States. There's a lot of people buying gold, which is why gold is so strong, as we can see. We had a lot of weakness on the Australian dollar, which is why a lot of people were buying against it and making a lot of money. This is a very important thing to use, the currency strength indicator, and it will help you a lot with this strategy. So pretty much here's the rules, okay? I'm going to write this out and put a nice handout sheet. That way you have really good set entries for your trades. Is there a hidden divergence on the 1 hour? It has to be 1 hour, okay? 1 hour, right? And you can trade majors, minors, gold, silver, oil, whatever you want. I prefer the major, minors, and gold only because they're a lot better and easier, more volatile, right? Then, if that's a yes, then you have to look. Is there a trend which confirms the divergence? If there is, like let's say for example, it's in an uptrend and you see a bullish hidden divergence, then you're going to buy because it's just a little pullback. And does the currency strength indicator agree? If it's saying, yeah, it's still going to keep going up because this pair is strong, then most likely you should buy or do whatever these 2 confluence factors said. Okay, and the last one is extra conditions like news and World War III, right? You know, you have things with Iran and non-farm payrolls. You have to keep up with those kind of thing, you know, because you don't know if it's going to spike up or down, and you really want to avoid those situations because there's a lot of slippage and bad things that can happen. Stop loss can get triggered, and guess what? You just lost money. So, time for some real-time examples. Okay, this one's one that I just pulled back, found on the 1 hour chart for the Euro USD. What do you notice here? Hidden divergence, first thing, right? What else do you notice? It's in an uptrend. It's kind of in an uptrend before this, but I couldn't fit it on the page. Pretty much uptrend all the way up, higher lows, higher highs. And then what do you notice here? Hidden divergence, right? So let's say you bought, boom, it spike up. So where would you put your stop loss? Perfect question. This dot represents my entry. I would enter somewhere around down here, you know, and get a pretty good entry. Where would I put my stop loss though if it went against me? Well, you'd want to put it at the pretty much the bottom of where the divergence starts. So we drew the line from this point here to this point here. And if we look up from this point, there's our low. So if price comes below this level, right, that means we would be wrong, okay? And so that's why our stop loss is right there. I usually put it a few more pips under it if it's like a really small stop loss, between 10 to 25 pips. That way I get a little bit more space to move just in case it kind of spikes or does something crazy. But I prefer hard stop losses over soft stop losses or stop loss zones, because what happens if it just spikes and closes and screws you over? Kind of like gold did. It's really dangerous to trade that way. And take profit, 2 to 1 risk reward is pretty good here, right? Let's say you risk 3% of your account. That means you get 6% of your account back if you win, all right? So let's look at, this is more confluence factors or more points of agreement for this entry, okay? Right, we have our divergence. This is the same trade, okay? What do you notice here? I put a Fibonacci retracement here, and what do you notice? It reversed down to what's known as the golden zone between 0.5 and 0.618. And if you bought right around in this zone, look at this, boom, spikes up. Perfect. Right, here's another one. Before this, there was actually a little hill, I guess you could call it, and that could be considered support when price breaks over and comes back down. It got fairly close. I wouldn't really use that as my entry reason, but I'd use the Fibonacci in this case for my entry reason and the hidden divergence along with the trend, and that would give me a very powerful entry. So that's pretty much the strategy, and that is, it's really simple, guys. It's really simple. If you have any questions, just let me know. So when it comes down to risk management, this is probably the most important part. If you just consistently lose with this strategy, it's okay because you won't be losing your whole account, right? People are putting on one lot sizes for like a $50, $100 account. 10 pips blows your account. 5 pips blows your account. That's ridiculous. That's ridiculous that people are doing that. Okay, so don't try doing that. Slow and steady will win the race, and you will get more and more money as it exponentially grows throughout time. So you're going to risk a set amount of your account. You can decide. For beginners, I recommend 1 to 2%. If you're really confident, maybe 3. Maybe 3 if you're really confident and good with your strategy. Okay, so start with 1%. Right. This example, I'm using 3%, right? So that means if you lose the trade, the entire trade just hits stop loss, boom, you're out, only 3% of your account is gone. So if, let's say you have a $100 account, you lose 3%, you only lose $3, right? So you have $97 left. Right? You don't lose a lot, but your reward is large. Okay, that's pretty much how this risk to reward ratio thing works, right? If your risk reward ratio is 1 to 2 and you're risking 3%, that means your reward is going to be 6%. And what's 6% of $100? $6, right? So you'd lose $3, but you can make $6. See how that works? Pretty cool, right? So now you're asking, okay, well, where do I place my stop loss? I kind of said before, you want to place it where the bottom of the divergence peak was, so down here, right? But pretty much the reason you have a stop loss is this, is to know that you're wrong. The reason you put a stop loss at a certain place is because if price goes there, that means your trade is no longer valid and you're wrong. So when we have a hidden divergence, what happens? Let's look back at the picture. You'll notice on this one, for example, right? This is a bearish hidden. Price is going down. We see indicator go up, which means, you know, bearish hidden divergence, so sell. Now what happens if price goes above this peak over here? We just made a higher high, and this is a higher high, and that's just normal. That's not any type of divergence at all. So now our divergence is no longer valid, and what happens when our divergence is no longer valid? The trade is no longer valid, so you might as well close it. So once it reaches this peak, I almost always close it because there's no point in letting it keep on going, right? That's why I have this stop loss in place here. If price goes below this area here, this is just lower low here and lower low here. That's not a divergence at all. So if price goes below this level here, you want to close the trade. Okay. So I showed this here. Price follows the arrow and goes down, then you close the trade. Simple as that, right? So now you know where to put your stop loss. Now you know where to put your take profit. And now you know the entire strategy pretty much in whole, right? You can use whatever you want tools-wise and pretty much succeed with this strategy. Now here's kind of the annoying part for most people is the position size calculations, is right. How do you know how to only risk 3% of your account, right? If your stop loss is 20 pips, how do you know that if I lose, it's only 3%? Pretty simple, guys. This is called the position size calculator by MyFX book, okay? At the end of this video, I'll show you how to get there. You pretty much put your account currency, your account size, and your risk ratio, right? For here, most of you beginners would put 1% or 2%, okay? So put 1 or 2%, and then you put your stop loss, right? So let's say, right here. Let's say you enter in here, and this is your stop loss, right? Let's pretend this is 25 pips. okay, we would put that into here. Our stop loss is 25 pips. The currency pair we're trading is Euro USD, right? And we hit calculate, and then this is what we get, right? Money, units, and lots, right? So this, if you lose the trade, you're going to lose $30. Ignore units, but this is the lot that you're going to enter in with. You're going to enter in with 0.12 lot size into this trade, okay? And that way, you would only lose 3% if it hits your stop loss. And this is perfect risk management, right? If you do this, this is good risk management, and you will succeed or not lose a lot of money. You know, don't risk more than you have, and don't waste your trades and time. You know, you're going to lose some, guaranteed. Guaranteed. I guarantee you're going to lose some. But make those losers small and make the winners big, and that's how you will succeed in Forex. Now, this is for kind of like the last little extra bits that I didn't really talk about too much, but watch out for news. That's the biggest thing, right? That's the important part of having a team of people, all right? You can keep each other connected on news events just in case somebody else misses out. You can keep each other there on entries. If somebody misses a currency pair and you see it, then guess what? Maybe everyone just made money off of your little scene. You know, it's teamwork, team effort, okay? And always have a stop loss. That's what I don't like about stop loss zones and all that crap. There's no guarantee that it'll get triggered. If it just spikes past and, you know, say you're taking a dump and you miss it, boom, you just lost a bunch of money because you were taking a dump. That's stupid. That's really, really stupid. Okay, and proper risk management. It's that simple, guys. And the final thing, guys, is I'm here for you, you know? Just DM me if you want help or anything. I'm pretty much available all the time. Live in the US Central Time. So you can just hit me up and I'll answer you. And I'll tell you, you know, I just give this away for free because I want to help people and I want to build a team of the best traders. That way we can succeed together, you know? That's the whole point of this. So here's the websites that I was talking about. The MyFX Books Position Size Calculator. The Currency Strength Trader. Just look it up on Google and it'll pop up, right? Or DM me if you want the link and I'll send it to you. And then Telegram is what you can message me on. But yeah, pretty much that's it, guys. I'm going to give you guys a few more examples, and that's it to this strategy, right? Here's 5 examples actually I saw today. I was not able to get into the trades, sadly, because I was busy with other things during the day, and these happened. I was literally like a few hours late on all of these. Actually, I was 3 hours late on most of them, 2 hours late on other ones. So these are the hourly charts, right? So for this one up here, you know, you see hidden divergence. Price went higher, OBV went lower, hidden divergence, right? What you notice here is actually kind of an uptrend. You see higher, higher. I would say like this. Boom, 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 boom. That's actually an uptrend. And if you study something called Elliott wave theory, that's an uptrend. 1, 2, 3, 4. It's going to push up 5 for the 5th wave. 5th wave theory, Elliott wave theory, same thing, right? So let's say you place your buy here. Your stop loss would be down here, and your take profit would be somewhere up here. I'll put it a little lower because this is a very wide stop loss, right? And that's what stinks sometimes, but you know, take profit, right? Take your profits off the table sometimes. This one's an even wider stop loss, okay? These weren't even our best trades, believe it or not. It moved the most pips, but they weren't the best trades. This is how wide our stop loss is. Let's say we had we caught this many pips, it's still 1-to-1. If we risk 3%, we only won 3%. But still, it works, as you guys can see, right? Lower on the OBV, higher on price, buy here, boom, spikes up. This is another example of Elliott wave theory, right? Up, 1, 2, 3, 4, last wave up, 5. And guess what? It worked, right? And then let me see. This one here, same thing, really wide stop loss, pretty much the same exact trade, guys. It's straightforward. Stop loss goes down here. Stop loss in this case actually would go here. So this is a really good risk reward ratio. You're risking this much and you've already got close to 10% if you risk 3%. You know, 10% of your account is amazing. This is another one. This was actually one of my favorites, right? Because you can see here, 1, 2, 3, 4, 5. You're going for the 5th wave to the upside, and you notice you got price going higher, and the OBV is going lower down here. This thing will move. But yeah, you guys will notice that, and yeah, simple as that. Same thing here. Short in this case. All of these were buys. This one was actually short. You see downtrend. it's pushing down, and then there's kind of a little bit of a stall here, which is why I shorted. And all of these, the currency strength indicator, agreed on. Here it is. All of these, it all agreed. So yeah, that's my strategy, guys. Hope you guys enjoyed that. Make sure to hit me up if you have any questions, and it's pretty much simple as that. All right, enjoy.